Everyone, today we are going to understand the basic concept of derivatives, and further we are also going to discuss its various types. Now let us first understand the basic meaning of a derivative contract. See, it sometimes happen that we enter into a contract, okay, with other person, okay, to buy or sell something at a future date, okay, to benefit from the price fluctuations. Okay, we may expect that the price of so and so commodity is going to rise or fall in future, and therefore we, in order to keep ourselves in safe zone, we enter into a contract with the other party, okay, to benefit from these price fluctuations, right? So this is what is derivative contract. Okay, so derivatives are basically the financial contracts that derive their value from an underlying asset, which is price in this case. Okay, now who are the participants in the derivative markets? The first one are hedgers. Now these are the investors with present or anticipated exposures in the underlying assets. Now let us talk about share market. Okay, in share market, let us assume that I am having 100 shares, okay, which is underlying asset. Okay, shares, bond, mutual funds, these are basically the underlying assets, okay, from which the derivative contract will derive its value, which we are going to discuss in a while. So basically just remember this thing, that bonds, shares, mutual funds are the underlying assets. So who are hedgers? Hedgers are the people who are already having some exposure to underlying assets. Okay, they are subject to market risks. Okay, they can also enter into derivative contracts. Okay, when they feel that the price of certain share or bond can fall or rise in the future, they can no doubt enter into a derivative contract, although they are having underlying assets. Okay, now the other one are speculators. Speculators are basically those investors who first take a view whether the price will rise or fall in future and accordingly buy or sell, okay, derivatives to make futures from the future, make profits from the future price fluctuations. So what is the difference? See, speculators are basically those who are not having any underlying assets. Okay, they are not having any share or a bond, but they are entering into a derivative contract. That is, they are entering into contract in which they will be buying in future, they will be selling in future. Okay, okay, there is no underlying asset, there is no underlying asset with them. They are just entering into a contract to buy or sell in a future. Okay, it's all imaginative, it's all arbitrary, it's all not an underlying asset, right? Then the other one is arbitragers. Arbitragers are basically those ones who take a short and long term position in the same or different contracts at the same time to generate risk less gain or profits. These are basically the people who are trading in various markets, okay, in order to compensate the risk. Okay, they are just willing, they are just generating a risk less gain or profit, right? Now let us discuss the various types of derivative contracts. The first one is the forwards. Basically, it is the oldest form of derivative contracts. Okay, here what happens is the parties enter into an agreement of buying and selling something in future at a pre-decided rate. Let's say I enter into a contract with a person, okay, Mr. Sohan, okay. I enter into a contract to buy 100 kg apples from that person in future at a certain price, because I expect that the price are going to, let's say, rise in future. So I enter with a contract with Mr. Sohan to buy certain kgs of apples in future, okay, so that I can gain from these price fluctuations. Okay, so this is a forwards contract. Okay, see, the other one is futures. What is futures? Futures is basically performed on the, executed on the, in the stock market. Okay, so the basic difference between forwards and future is that forwards is not performed on the, in the stock market, right? But futures is always executed in the stock market. See, the parties enter into a contract and fulfill the agreement on a future date. Okay. For example, Miss Sonam expects that the price of Indian oil shares will rise in future. Okay. Let's say due to hope of increased production of oil or crude oil, right? On the other hand, Mr. Arjun believes that the price will fall. Okay, now they both are entering into a contract of buying and selling in future the basically shares in future, underlying assets in future, and they are entering into a contract. Okay, now the other one is options. Options are basically those contracts which are having the flexibility that it can be upon the buyer or seller to follow or not to follow the contract. For example, I am entering a contract with someone of buying certain shares in a future. Okay, because I expect that the price will rise in future. That's why I'm entering in a contract with other person to buy the shares in future. Okay, but let's say I choose an option. Okay, choose an option of not having the obligation to pay to that person in future. So this is what is called the call option. Call option is basically when the buyer has the right but not the obligation to buy at a future date, right? Whereas in put option, the seller has the right but not the obligation to sell in future. Okay, now what did we understand today? We basically discussed the meaning of derivatives. See, what is derivative? Contract, basically it's something, a contract basically, which happens between parties, two parties, okay, wherein they promise to pay each other or to execute a certain contract, buy or sell basically something in future at a pre-decided rate and quantity. Okay, even quality also. So derivative contract is something that is deriving its value from the underlying asset. Okay, we are keeping price as the underlying asset, and based on this we are making a transaction for the future, agreement for the future. Now we discussed about the participants in the derivative market, like the hedgers. Hedgers are the people who are having the normal underlying assets like shares, mutual funds. They are having, okay, and they are also subject to market risk. These people can also enter into derivative contracts when they feel that there is a risk or there is basically a problem. There can be a situation when the price can fall or rise. Okay, they can also enter into derivative contracts. Then the other ones are speculators. These are the people who are basically those people who first take a view of whether the price will rise or fall in future, then they accordingly enter into a derivative contract to buy or sell at a future date. Okay, they are not having the underlying assets, they are just entering into an agreement to buy in a few on a future date, right? Then we talked about arbitragers. These are basically the ones who are taking short and long term position in the same or different contracts, okay, at the same time to generate a risk less gain or profit. Okay, they are basically trying to eliminate the risk, okay, by investing in other markets. Okay, then we talked about the types of derivative contracts. The first one was forwards. We discussed that forwards is all about the contract which is not made on stock exchanges, okay, wherein two people are entering into a contract of buying and selling at a future date, okay, but it is not happening in a stock exchange, okay, on a stock exchange. Then we further talked about futures. Futures is basically when we are entering into a contract of buying certain commodity or share or mutual fund at a future date, okay, at a future date, okay, then we are entering into basically a futures contract. Okay, then we further talked about options, which is basically both the parties having right but not the obligation to pay or buy or sell at a future date. Okay, so we talked about call option, in which the buyer is having the right but not the obligation to buy at a future date, wherein put option, the seller has the right but not the obligation to sell at the future date, right? Now let us practice some questions. What does going long in future contract mean? Sell, buy, retain, hedge. See, when we go long in futures contract, it basically means that we are buying the future derivative. Okay, we are buying the future contract. Okay, so here the answer would be B. Whenever someone goes long in futures contract, it means that person is willing to buy that contract. Okay, which contract is executed in stock markets? Options, futures, forwards, both A and B. See, we discussed that forwards does not happen on stock exchange, futures happens on stock exchange. Okay, and what about options? Options also happens on stock exchange, right? So the correct answer would be both A and B for this. So this was all for today. Thank you so much for your time.